I am afraid that gold and silver are headed much higher. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad times. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. I certainly don't have the preponderance of my net worth in gold, just like I don't have the preponderance of my net worth in any insurance product.
Esteemed investor Rick Rule delves into the intricate dynamics of the global economy. Rule explores the delicate equilibrium between central banks' tightening policies and the expansive fiscal stimulus, underscoring the imminent threat of a liquidity squeeze due to escalating Treasury issuances straining the private sector. As the conversation unfolds, Rule emphasizes the enduring appeal of gold in such uncertain times. Gold, often referred to as the ultimate hedge, emerges as a beacon of stability amid economic turbulence. Its historical significance as a store of value remains unmatched, making it a sought-after asset in times of market volatility. Rule discusses how gold acts as a reliable safeguard, preserving wealth and providing investors with a sense of security amidst fluctuating currencies and economic uncertainties. Intriguingly, the discussion highlights the potential role of gold as a strategic portfolio diversifier, offering a shield against inflation and currency devaluation. Let's dive into the rest of the video.
The banks, if they pretend that they're going to hold that bond on the books, are allowed to carry it at par. Silicon Valley Bank, when they experienced their liquidity crisis, when they had problems, and they had a different problem, another problem, concentration of funding. When the overnight funding began to go away and they had to sell their bond portfolio, they had to sell the good part first. And so all the stuff that was floating rate and near term, there was a market for. There was a bid. They sold it and they got cash. All they had left over was the underwater bonds. People need to pay attention to that. Depositors need to pay attention to the solvency of their institutions. Investors need to pay attention to whether or not the institution is run by sober adults. And borrowers, too, need to do business with banks that will be there to meet their funding needs 4 years from now or 5 years from now. Just do a little work. Don't trust the big thinkers to do your work for you. And that spills over into the broad economy. It is true that Citicorp and JP Morgan Chase and Bank of America are literally too big to fail. They will not be allowed to fail. But if you do business with them as a borrower, they will expand and contract their balance sheet, which is to say they are not necessarily good suppliers of capital to you. And you need to pay attention to that. And the length and breadth of U.S. industry has to pay attention to the variability in access to credit afforded by the big banks, given the state of their balance sheets. Taxpayers need to pay attention to something else entirely. Taxpayers need to pay attention to the contingent derivatives liability on the big bank's balance sheet. I realize this is a very boring soliloquy for some of your listeners, but some of the big banks have nominal derivatives exposure of 20 or 30 or 40 trillion dollars on their balance sheets. They will say that these aren't net liabilities, that they offset each other, that their real liability rather relative to their nominal liability is very low. That's only true if the counterparties pay. If you are trying to operate a $40 trillion derivatives portfolio on a $250 billion balance sheet, it's very difficult arithmetic if there's even one perturbation in financial markets, and I suspect that there will be more than one. I'm really concerned about that. I'm concerned about the impact not merely on investor confidence, but I'm really concerned about the impact that a hiatus in funding would have throughout the length and breadth of the global economy. You used to live in Southern California, and I don't know if you ever were, But there's a wonderful little bank down there. This is not a commercial for the bank, by the way. I'm a competitor. There was a wonderful little bank called Farmers and Merchants Bank of Long Beach, founded in 1910 by the Walker family, run in 2023 by the Walker family. They have their whole net worth in the bank, which means they watch it very, very, very closely. Equity as a percent of assets is about 20. They match their assets to the liabilities. It's a really, really, really well-run bank. And if the country had more banks like Bank of Hemet or Farmers and Merchants Bank of Long Beach or First National Bank of Alaska, we wouldn't have concerns about a credit crisis. But it's not. And we do.
Right.
It's such a shame. Buffett points out that a community bank is one of the only businesses in the world where a well-run bank can earn 15% after-tax returns on equity and reinvest the 15% at a 15% yield. If you do that without a hiccup for 10 years or 15 years, you've made a truly staggering amount of money. And the idea that the big thinkers take this equation to an illogical conclusion is an insanity. I am afraid that gold and silver are headed much higher. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad times. I got a lot of questions at this conference I was just at about, will gold break through 2000? I don't care. I don't own it because it would go from $1,925,000 to $2,050. I own it because of the lessons that we learned in 2000, where it went from $253 over 10 years to $1,900. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. I certainly don't have the preponderance of my net worth in gold, just like I don't have the preponderance of my net worth in any insurance product. Gold to me is an insurance product. Now, I will admit, on occasion, I speculate as opposed to invest in silver. I do that because in my experience, when the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold, silver, for whatever reason, perhaps it's lower unit cost, travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. And honestly, Mike, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled. I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. I'm a credit guy, really. The market share of precious metals and precious metals related investments, securities, stuff like that, gold stocks, comprise less than 1/2 of 1% of total savings and investment assets in the United States. As Robert Friedland would say, a pimple on an elephant's behind. The 2-decade mean market share of precious metals among US savings and investment assets is 2%. So if concern about quantitative easing, debt and deficits, negative real interest rates became a little more broadly spread in the US economy, and if the market share of precious metals returned to mean, I'm not talking about crushing the bond market, I'm talking about returning to mean, demand for precious metals and precious metals related assets in the United States would quadruple. And that's precisely what I think is going to happen. As I understand it, no accurate statistics, but JP Morgan Chase estimates that it was between 5 and 7%. Doesn't mean it's true, but we don't need that inflammatory number to make our case, Mike. All we need is reversion to mean. Reversion to mean quadruples demand in a market that's 22% of the world's savings and investment assets.
Thank you for joining us in this illuminating discussion with renowned investor Rick Rule. Today, we explored the intricate interplay between central bank policies and fiscal stimulus in the global economy. We discussed the imminent threat of a liquidity squeeze due to escalating Treasury issuances and the challenges to the Fed's credibility in the face of persistent quantitative easing. One key takeaway is the enduring appeal of gold as the ultimate hedge, offering stability and security amidst economic uncertainties. As a reliable store of value, gold stands resilient, providing investors with a strategic diversification option in their portfolios. For more in-depth insights into navigating the complexities of the financial landscape, stay tuned for our upcoming videos. Don't forget to like, share, and subscribe for more valuable content. Until next time, happy investing.